everyone, welcome back to ASX Market Watch. Thank you very much for joining me. It's actually great to have you here checking out the markets. We are covering so many tools today, it is just crazy. And it's also a good thing for you because if you take these tools and use them in your own personal trading, which you can, then you can actually use them to make money or to help save yourself money in the markets as well. So they don't just work on the indices, which is what we check out. We look at the indices, guys, so the All Ordinaries, the Hang Seng, the Dow Jones, the FTSE, we look at these because we want to determine which way the market is heading. And if we know which way the market is heading, we want to be trading in that same direction, just to put the odds of probability on our side. That's why we do it. But looking at individual tools today is a whole different kettle of fish, because different and individual tools is what we can actually use to physically make money in the markets. And that is what I want to show you today. Really exciting stuff. So let's get into it, guys. And again, thanks for checking it out. It's a couple of minutes out of your day, but I promise it'll be worth it. It's really excellent stuff. All right, now, first one we're looking at, as I said, we're looking at them all. The first one we're looking at is the All Ordinaries, which is very similar to the ASX Top 200. So these two run in very similar circles. Why? Because the top 200 stocks in the share market are probably, well, they're the most heavily weighted stocks, so they really do run very similarly. Not exactly, but very similarly. Now, the first thing I want to show you is actually something that was brought to my attention by a reader. Tony, absolute legend, has emailed me and he's said, we've got the 50% retracement, which, by the way, William or W.D. Gann said was the strongest retracement level that you could possibly find. So from the very top of the bull market, guys, this is the very top of the bull market to the very bottom of the bear market in 2009, that last capitulation there, when everyone freaked out and sold and then allowed the market to start rising again because the weak hands had been gone from the market. If that makes sense, I hope it does. But from the very top to the very bottom, the 50% retracement level, where is that? Here it is. It's at the 5,000 mark. So not only is the 5,000 mark a very strong level in itself because it's a very round number, for some reason investors tend to hang around round numbers. They tend to be support and resistance. This is just I'm not sure if it's a psychological thing. I would hazard a guess that it is. We're very emotional beings, human beings, so this can be correct. But look, 1, 2, 3 times it's bounced off that 50% retracement level, being, as W.D. Gann said, the strongest retracement level, or strongest resistance level in this case. And the market has not been able to go above it, and it still hasn't. So that's what we're looking for in the future as resistance. But I want to take it one step further, guys, because we really can. And if I just enlarge this chart again, we're looking at only the last couple of months here at the end. Now, what have we got from the top of our recent move up to the bottom of our recent move down, which happened only over a couple of weeks? It was a very quick move down. This is from April to May, basically, 2010. Now, that move, where are we at the moment? And I'll just enlarge it so you can see that. But there's our 50% retracement level, and what have we got? 1, 2, 3 times the market has bounced off that level as well, and it cannot close above it. In fact, just on Friday, it literally tried to close above it, could not, and basically was sold back down to a level below that level. Now, what's the significance of that? Well, let's throw another tool into the mix. And by the way, thank you, Tony. Absolutely great call. Thank you for reminding me of that. That is a fantastic thing. Now, let's add this other tool to the mix, because this is a weekly chart now of the All Ordinaries. And what we're looking at is peaks and troughs. Very simple stuff, guys. Anyone can always look at peaks and troughs on a chart. You don't need any fancy indicators. You don't need any MACDs or oscillators or any other crap like that. I'm not kidding. This is the real price that we're looking at, the solid price. This is where the action happens. And that's what all the oscillators and indicators are based on as well. So you're going to the real heart of the matter, which is the best part. So this is our same move down in April on a weekly chart now. Peak, higher trough, lower peak, higher trough. So literally, we're getting squeezed into this little section here. And what we're looking for and what the market could not do on Friday was close above the previous peak. Now that would be giving us a Dow Theory entry, or at least one of Dow's theories from his writings in the late 1800s. Charles Dow, one half of the Dow Jones Index, because he was such a great part of the industry at that stage. So that was one of his writings, higher peaks and higher troughs. If it's going to close above that previous peak at 4,624 roundabouts, or probably 4,650 just to be safe, guys. If it closes above that on a weekly basis, happy days, that's your Dow Theory entry. And that's a more solid entry signal, even though we're still in this sidewards range. That would give you a pretty good signal as a buy signal according to that theory. So that's one thing on the All Ordinaries, and that's what we're looking at, and that's basically what we're looking for. But there's a lot of resistance, as we said. Now, the next one, moving on, is the Dow Jones. Dow Jones, very simple stuff again. Oh, actually, let's look at the let's look at the FTSE, because it's a bit more exciting. What we've got here, this is the weekly chart on the FTSE in Europe, and we've already got our Dow Theory entry, as you can see. So that's exactly what I was talking about on the All Ordinaries. We've got peak, higher trough, and then it's gone through the previous peak, zigzag up. And we got that last week, guys, so that was at 5,425. Where has the market gone since then? It's gone up. It's shot up because everyone else has seen the signal as well. Either that, or it's just one of those signals that really works with the market. It works in harmony with the market. That's what it's designed to do. So the market has gone up since our signal, which is what we intended it to do. It's what we wanted it to do. It's what we said that it would do. And that makes me happy. I mean, it's nice when that happens. Again, we're still in this sideways movement. This is a weekly chart again. It's a lot of data. It's over the last couple of years. Each of these bars is 1 week. But yes, we're still in this sideways movement, but that was our early indication. That was our Dow Theory entry. The market has gone up since then. And again, in Europe, people are shrugging off a lot of bad news. Like, there is still bad news coming out, but people are ignoring it. And that's a good sign that people are ready to buy again, guys. So that is that's basically the FTSE there in Europe. This is the Dow Jones. So coming back to the Dow Jones, lagging behind a little bit. Again, this is a weekly chart. So as you can see, we've got our peak, we've got our higher trough, nowhere near our next peak. Nowhere near it just yet. So the Dow Jones is really lagging behind, very much still in this sideways movement. Why do we know that? Because this is our downtrend line here. We've got our uptrend line as well. They tend to act as support and resistance in the future. So we know it's already acted as support at the 10,000 level there. And that's what we're looking for. It's basically going to sort of keep continuing in this little range here between 10,000 and 11,000. When it breaks out, we'll know which way the market's heading. And again, there's a lot of support at 10,000, so a lot of support. There's someone or something looking to keep the market above that level, whether it's just to keep investors safe, whether it's to stop people from capitulating and selling all their holdings, or getting caught by stops and margin losses, margin calls. Yeah, basically, whatever it is, the market doesn't want to go below 10,000, and it doesn't want to stay below it for very long. And that's a good sign. It means that, you know, there are buyers out there. If it closes below it, could be in trouble, guys. Because chances are there are a lot of stops, a lot of stop losses below that level, at least maybe a significant amount below that level, 9,700, 9,600 approximately. So I hope that helps on the Dow Jones. Now that brings us to our last one, the Hang Seng. And that's in Hong Kong, in the Asia region. Again, very close by neighbors to Australia, which makes me happy. We had our uptrend line crossed, and I'll just see if I can enlarge that. I'll make this a bit more solid as well. Get rid of that. There we go. So there's our solid uptrend line. On a daily chart, on the Hang Seng, it's closed below it. So these are our, this is in Hong Kong, closed below it, hasn't made a lower peak or a lower trough. That's what we were looking for a sell signal. Could not do it. Could not do it. Then the market rose. So it couldn't give us our exit signal. It continued to rise. And now what's happening? It's basically still rising. And where is it finding resistance? Let me just show you exactly. There we go. This is our downtrend line here. And our next resistance point is around 21,700. So that's according to our trend line, which gives us support and resistance in the future. Exactly right, guys. Spot on. So that's what we're looking for. And again, it's been in this range, in this sideward range for about, probably about a year now, maybe even longer. But when it breaks out to the upside, we're looking at a target of between 24 and 28,000 on the Hang Seng. Now, this will take some time to evolve. but if and when it does, it's going to be very happy days. And why are we looking for that? Because this little sideways movement here is what looks like a continuation pattern. Also, it looks like a 1, 2, 3, 4 wave 4, which tends to be a sideways movement in the Elliott Wave series, if anyone follows that as well. When it breaks out, your wave 5 target, yes, is around 24,000 to 28,000, based on Elliott Wave projections there and Fibonacci projections, if you follow that stuff as well. Last week we went into it in a whole bunch of detail. So guys, that's a whole lot of tools and a whole lot of analysis, just checking out where the charts are going, and I hope that has really helped you. Whatever actually analysis that you use, I hope it's helped you in some way, shape or form, in giving you another point of view on where the markets are heading, because it's great stuff and you really can get into it. It's a whole bunch of fun. Other than that, I will see you next week, and hopefully there's a whole bunch more fun to be had and a whole bunch more tools to be looked at. See you next time, guys. Bye.